So when we talk about risk and uncertainty, there is an element of statistics and statistical theory as well, which differentiate the two. Risk is when we know the potential outcomes, but we cannot quantify at that given point of time what is going to precisely happen. So we can just say that, all right, there are two chances. So for example, if we need to talk about risk today, we know tomorrow it could be a rain or a non-rainy day. And there could be 50% chance of both. However, whether a cyclone will come tomorrow or anything else happen, we can't tell about that. Or we might say that there is a 0% chance of a cyclone because there is no such prediction. So in that case, we have different potential situation: rain, no rain, cyclones, or any other thing. But when we are running a business like a factory or manufacturing house, we again have two type of situation. When we have a risk, we know what could happen: a strike or lack of supply or any accident. We can put a number, 20%, 30%, or 10%. But then imagine those things which is considered as completely out of the blue moon. No one could have foreseen. It could not have been envisaged, but it happened. And those are uncertainty. When you don't know even the probability of that, it is uncertainty. When you can't even predict whether what are the different factors which are likely to happen tomorrow, that is uncertainty. But when you know what are the different things that can happen tomorrow, you just don't know the probability, but you know what are the things that can happen. You know A, B, C, D, 4 options. You just don't know the probability of that. You don't know whether A is going to take place by 10% or 20%. That is a risk. But you know what could happen worst case. So that is risk. But uncertainty is when you just don't know what can happen tomorrow. You're planning to go out to office, maybe office could be closed, but then you don't know that some friend will come and visit you who was not seen for 10 years. That is completely out of the blue moon. That kind of thing is uncertainty, right? So just think from non-academic basis, on day-to-day basis. Risk is when you know the potential outcomes, but you don't know precisely what will happen, but you can calculate the probability in terms of percentage. Then it is risk. When you don't have any clue what could happen tomorrow, that is uncertainty, right? So that is the key difference between the two. What is covered by the insurance? We'll cover that. Okay, so this also reminds me of a very popular term nowadays, black swan event. So what is black swan? This is kind of uncertainty. Uncertainty to the extent that we think this cannot happen, this can't happen, but when it happens, it is devastating, like coronavirus. Now people think that, oh, it is kind of very improbable, it cannot happen. Or some kind of suddenly there is a factory and there is an acid rain. These are example of uncertainty. You can't even foresee. You don't put that as one of the option, but it can happen. And if it happens, it can have massive impact. So that kind of uncertainty is called black swan. Just to remember and associate this to uncertainty, it will help you remember longer that black swan is one type of uncertainty, and risk is when you already have 4 options A, B, C, D given, and you can put a probability number, then it is a risk. Now, as per the book, risk is sometimes used to describe situation where outcomes are not known but probabilities can be estimated. Uncertainty is present when outcomes cannot be predicted or there cannot be any probability assigned to this, right? Like a black swan or like an acid rain or maybe a coronavirus outbreak or something else. Then exogenous variables are variables that are determined externally. So any factors which impacts the organization and can be determined only externally, that is exogenous factor. Exogenous means from outside environment. The literal meaning of exogenous is outside environment. So exogenous variable will be determined by the external forces outside the organization. Type of risk and uncertainty. What are the different types of risk? So when we are doing, and even I work in my organization on day-to-day basis, we are aware of what are the different issues that can take place. And since we are aware, they are risk. I know that some staff can resign, some can fall sick. There could be system or technological interruptions or something like this. So since I can visualize that those things are possible to happen, like physical issues, or any earthquake or flooding, those things can take place. Or there could be economic crisis or business issues, product life cycle, maybe a competitor launching new products. When I can envisage those things, but just don't know accurately what is going to happen, it is a part of risk. So physical risk, earthquake, fire, flooding, equipment breakdown. And you can make your own list. It could be just a long list of issues. Economic environment might turn to be wrong. And there could be again 10 different risk from economic perspective. Interest rate risk, inflation, or maybe some fiscal issues from government, foreign exchange issues, so maybe international oil market issue. So many different things can happen, and those will be part of economic risk. Business, the list could be even longer. It could be technological disruptions, the competitors launching new product, price promotion, cost, and any other price war, lack of supply, lack of intermediaries, logistic issues, supply chain issues. Maybe supply chain was taken over by the competitors. So many different things. Product life cycle, then political, different risks exist at different stages of the life cycle. So when your product start to decline or maybe your product is at the maturity level, at that point of time, you need to be aware of the decline and how to relaunch the same product with a new feature so that it does not decline. Because if it starts to decline, the competitor will launch their product at that point of time and it will be well accepted by the competitors. So that is called product life cycle risk. Political, nationalization, sanctions, civil war, political instability, we all know. Financial risk, stock market crash, interest rate hike, or maybe banking crisis, bank do not want to lend money, liquidity crisis, liquidity crunch, those will be the financial risk. Okay. Even your counterparty defaults, somebody who was somebody who had borrowed money from you has defaulted. So that will be financial risk. So these are typical risk. And from the perspective of the risk management, because when we are accounting for risk, it is important to understand what are the different ways to also manage the risk. So you can do 3-4 things with risk. Transfer the risk. That is typically done through insurance, right? When you take the insurance, you transfer the risk. Secondly, absorb the risk. What else can be done? Prevent or mitigate. Okay, you can also call it avoiding the risk. So transfer, absorb, prevent, mitigate, avoid, and then finally you can just share the risk, because these 4 are standard steps to manage the risk, and accordingly you can better understand how to do the accounting for them. because when you are doing the accounting, you have to take one of the 4 steps, or you have to accept one of the 4 way of handling risk. So how do we account for risk? A firm might require that all investments make a return of say 5%. This can be adjusted for risk. So this is called risk adjusted return. Okay. In the investment industry, there are Sharpe ratio, alpha, etc., used to assess how much risk we are taking and what is the reward associated with that. Okay, so return can be calculated using various ratios like return. The target return could be raised to compensate for the risk. Okay, because risk and return has to go hand in hand. If there is high risk, there has to be high return as well. So once we quantify the risk element, we can also increase the reward, because risk adjusted reward can be constant. So if somebody, one bank has 5% reward but no risk, then it is fine. We can expect 5% reward. But if another bank has 2% risk overall, a ballpoint number, then the reward should be 7%, because after the adjustment for risk, it will still come down to 5%. Payback. To protect cash flow, we might have a condition of all new investment projects that should pay back within a certain period of time. So what is a payback? Just to introduce quickly. So imagine that you have invested 100K into a project, and the project will give you the cash flow for next 5 years. Okay, all the cash flow, say XK, YK, ZK, will be calculated for the present value. And then you need to assess that once all the cash flow is calculated to the present value, how long will it take to recover that 100K of initial investment. So that is the way for payback. This is how payback is calculated, and it is critical for accounting for risk. Then finance. It might be determined that the investment should be financed under strict conditions, only from profit, so that we don't take undue risk. Why? Because if we don't finance it from the profit, which is the retained earning, there could be further risk, because if we issue the bond or we borrow from banks, bank will have expense charge, interest expenses. That interest expense will further increase the risk to the project and the organization. Hence, if the organization has sufficient profit and retained earning, it is better to finance with retained earning. But of course, not all the organizations have that privilege, because there has to be some distribution and dividend as well from the annual profit. Planners try to quantify the risk using some of the statistical theory, such as rule of thumb, basic probability theory, spread of value. There are some equations like some ratios like VAR, value at risk, which use standard deviation and percentage of probability, etc. So how do we use rule of thumb? This might express a range of values from worst possible results to best possible results. We'll learn about this in later sections, something like maxi-min rule or maxi-max rule, right? There are 2 rules which are similar to rule of thumb. So we are trying to say that what could go worst and what can be the best in the worst circumstances. Okay, what could be the best outcome even though something worst can happen, right? Or the third option could be what is the best case scenario, or what could be the best in the or what could be the worst in the best case scenario. There's so many different way of looking into the outcomes in the project. Again, which option do we choose? It depends on our risk appetite, whether we are risk seeker or risk averse. That will decide whether we are going for best of the worst or we are going for best of the best outcomes, right? So those are the meaning for the rule of thumb. Basic probability theory. By now we might have already understood. We can apply probability theory to anything in the life, right? Whether the internet connection will continue to work next minute, or the electricity will continue to sustain the next minute, what will happen tomorrow, with whether all the epidemic will subside within a month. Everything has a probability. So long as we know the event, we can assign a probability. So basic rule of probability says that if we have 2-3 different projects, we can assign the success rate to those projects. How much profit can be made with 10% or 20% certainty. So sometimes the project managers assign 3-4 different profit measures. Like I can say that if I go for project A versus project B, there could be some profit outcome like this: 100K, 200K, and 300K. Project A has 20% chance of 100K and 25% chance of 200K, but somewhere like 55% chance for 300K of profit. But project B has 10% chance of 100K, 10% for 200K, but 80% for 300K. Apparently, we see that B is better. Though we are still talking about the percentage and the probability, but we can clearly see that project B has higher chance of biggest profit. So this is how probability helps us quantify the outcome of projects, and then we decide. So this is a simple way of estimating the project's outcome using probability. Any questions so far? Stop me if there is any ambiguity. One way of measuring the dispersion or spread of value with a different possible outcome from a decision is to calculate a standard deviation. Okay, standard deviation is also called under root of variance. How do we, and what are the different ways to use standard deviation? Let me just jump to a PPT. We need to show a little bit more on this. So first of all, standard deviation, is under root of variance, which is calculated using x as a mean and distance from individual number minus mean and n minus 1. We take the sigma and square of this. So we take the sum of all the number x minus mean to the whole square 1 by 1 and then divide by n minus 1. So then it becomes variance or standard deviation. So the step and formula is long. I don't want to go into that just now, but this is a standard way to calculate the standard deviation. The objective here is directly to understand where do we use standard deviation. What is the meaning of this? Okay, because this paper tests actually the interpretation and meaning of standard deviation. So as the square root of variance, the standard deviation tests the dispersion from the mean or the central point, which also means that if you have a data of say 2 million people, how much variation from mean exist in the data. That is a very high level meaning of standard deviation. How do we use this? Let's have a bell curve. This is important to understand, and even from the APM perspective, because then all the discussions and the numerical analysis or question will make more sense, because we can visualize what is happening, what is the meaning of the terminology. So here we are, I was talking about the mean, right? So somewhere here, yeah, mean. So this is mean, also measured by mu. So if I tell that, hey, Sandy or someone, like, your score in the exam is 2 standard deviation from mean. So let's say 1 is here and 2 is here. 2 standard deviation from mean. What does that mean? That means 2 standard deviation is 95% away from average. So, i.e., you are in top 5%. So you are in this area. You are in the 5%. Why? Because you are 2 standard deviation away. How do we calculate this? Now there is a Z table, etc. used to find out what would be the mu and Z value to measure 95%. If I would have told you that you are at 1 standard deviation, okay, only this much, that means you are here, you are in this area, and that is top 35%, because 1 standard deviation means 65% of the population. So generally 1 means both sides of 1. So +1, -1, similarly +2 and -2 here. This is how standard deviation means. It tells you what is the percentage of your population in the entire crowd, right? So this also tells you that how much away you are from the standard or the mean. And this is how IQ, you know, the measure of the intelligence of the population, is also measured. So some people are in the top 2%, right? Or top 1%. So top 1% means the person is 3 standard deviation away from the mean. So 3 standard deviation away from the average people. Average is considered 100 in the world of IQ. So 3 standard deviation away means top 1%. Okay. So standard deviation is a measure of dispersion or the deviation from the mean and the average. That's the bottom line. Okay. Moving on to our chapter. So possible outcome from decision to calculate standard deviation of the expected value of profit. So if we see that there is a standard deviation of 2 for our profit of, say, 100K, if that is our mean profit, average profit, and there is a standard deviation of 2 for this project, that seems quite risky. Okay. Because 2 means there is a high standard deviation as compared to 1, of course, because 1 means that the profit of 100K and around this is quite likely, because standard deviation of 2 means it can go, again using our bell curve, that's why I introduced that idea, 1 and 2 standard deviation this much, then it can also go this way, -2 as well. So if my profit can travel this much of dispersion from the mean, I want it to be near the mean. But if it can go this much far from the mean, both sides, positive and negative, then I'm not comfortable. So standard deviation from the expected value or the profit, too much of a standard deviation is risky. I don't want that project. No, if I'm risk averse, basically. If I'm a risk seeker, if I love risk, then it's a different thing. I might be a good better. But for risk avoidance rule, it is not ideal situation. We try to minimize the standard deviation from the profit. So fast forward to decision trees. What is a decision tree? So if I say, let's use this the best approach. Normally people want to pass 10+2 standard or senior secondary, and they want to go into one of the career. So people generally ask that, do you prefer science or business? So somebody will say business. Okay, very good. So do you want to go for MBA or ACCA? Then person will say, no, I don't want to go for MBA, I want to do ACCA. All right. Then do you want to do MBA maybe in your country, or you want to do it abroad? So what is this? It is a decision tree. It could be in this format, or it could be in the yes or maybe no or yes format. So there could be different options given. There could be, rather than 2, there could be 3 options or 4 options given. But ultimately, you know that you choose one option and then there are 3 arrow or 4 arrow. Then again, you need to choose from the options and you need to ultimately arrive at your desired place. Then you just need to keep answering and you will arrive at the desired place and you get all the answers. So that is a decision tree that helps us to take the decision in the complex situation when there are so many options, stepwise decision required. Like in this case, we can use the decision tree. Decision tree, and in the Bayes theorem model, it is used in the valuation of the options. It is used in the valuation of the various derivatives, by the way. So decision tree is very, very popular method. It is also used in the valuation of the projects and the project appraisal. When we are valuing 2, 3 different projects, we use decision tree, and decision tree can be merged with probability, and I'll tell you how. So if we say, let me just delete this one. We can merge decision tree and probability together as well. So there could be a situation that there is an option, you know, the typical derivative, right? Option, the chance of option going in the money or out of the money. Okay, so below is out of the money. Imagine out of money and in the money. So this could be 60%, this could be 40%. And if it goes in the money, then earning 100K could be 70% probable, or maybe earning 40K could be 30% probable. So here we have a decision tree because we are constantly having 2 options, but on the same time we are applying probability 70%, 30%, 60% versus 40%. So this is a merger of 2 methods, and it can help us visualize the scenario situation in the future quite well. So see how we can use 2, 3 different tools in one model, in one discussions in business, and get a better clarity of what is going to happen to make the decisions. So how it helps clarifying strategic decisions when they are complex. As I said, it simplifies the situation using a risk as an input to quantify the decision model options. Why it is using risk as an input? Because when I talked about in the money versus out of the money, out of money is one of the risks, right? That it can be out of the money. So if we talk about out of the money, there could be one more risky items, and then we can just put a number and probability that what is the chance of being out of the money or crashing or going negative, right? So we can put the 10%, 20%, 30% to all the option that we don't like, all the risky side, and then we can visualize that, okay, overall risk seems to be 70%. And then 30% is the positive outcome. So we can use the probability as input to quantify the decision options. Ranking the relative cost and benefits of the options. So decision tree also help us rank the cost and associated benefit when we are doing the options valuation, or when you are appraising any project which has the option as well. So it just clarifies how the potential outcome is going to be in the future. And then having a probability helps us have a better grip on the outcomes, or to understand the outcomes. That said, many of the options in a decision may not be mutually exclusive. May not be mutually exclusive means it is not always necessary that the life will be or the business will be like A or B or C. Sometime you get a offer from a client which says, and we are thinking that it will be A, B, C, or D. The client might say that, you know what, you can take A and C, but if you pay me more, there is a option B, but I want option D. Now you think that, okay, what is going on? How do we apply that decision tree? Because not every time it will be as clear as A, B, C, D. That is, the decision tree not every time comes like this, right? Sometimes it look like a bundle of two and this together, and we have to really then apply much more complex mathematical models and decision methods to understand what decision to take. So not every time it will be like A versus B. It could be sometime A or B and C, like this. So it is not always mutually exclusive. So this is one of the demerit, one of the weakness of decision tree. And the decision tree may inhibit a creative approach to a problem by assuming that they are. Because sometimes you might have more options, but because of the decision tree or the trend which is followed, you might not explore all the creative options or creative ways. For example, sometimes we just think in terms of A or B, black and white, true or false, up or down, but life may not always be binary. There could be another way to do things. So finally, it is often easy to forget that an EV is only useful for comparative purpose, taking probability into account. It is not a prediction of an actual outcome, because EV, expected value, or probability is just an estimation. It is not a real reflection of what is going to happen. So it's just the best estimate and may not be real scenario, because that is known only at the end. Now, basic probability theory and expected value. How do we apply probability in the expected value calculations? Okay, so before going through the theories, let's jump into one of the numerical example. It helps understanding it better. So I have two projects, option A and B. So somebody told me that I have to choose between the two projects as such, like this. Probability 0.8 means 80%. Okay, by the way, this is how it is written. 80% is 0.8, 20% is 0.2, and it has to be always 1 or 100%. Okay, so whenever you think that something is missing, it is not 100%, check it again and read the question again. So it has to be 100%. So somebody gave me an offer that there will be a project which will give me cash flow of 5,000 with 80% probability and cash flow of 6,000 with 20% probability. And I have to choose one. What did I do? I just did a quick math here. 80% of 5,000 is 4,000 and 20% of 6,000 is 1,200. That 5,200 is expected value. Why? Because I know that 5,000 profit is going to be occurred with 80% probability, means 80 out of 100 chance is that I will earn 5,000. So what I should do, if it was 100%, I know for sure that the 5,000 is coming, right? You agree? Just applying the simple math. Proportionately, if 100% probability goes down to 80%, shouldn't I multiply 80% for my cash flow of 5,000? So that becomes 4,000. And then I have another percentage, 20%, because I know that in some cases 5,000 cannot be earned. Then the project manager said there is a 20% chance that I will earn actually more than 5,000. So that is 6,000. So applying 6,000 times remaining 20% is 1,200, adding them together, 5200, because you know I have to arrive at 100% all the time, because any probability, if you sum up all the probability, it is 100%. So this is 5200 rupees or earning is the chance that I'll get based on the probability, based on 100%. So if this probability is reliable, I'm likely to get 5200 from option A. Similarly, I do same mathematics here. Profit, in fact, here it is a loss. Sometimes the project can also give a loss, and there can be a probability for that as well. So 10% chance that there will be loss. So negative sign, right? We have to carry the negative sign because there's a chance of loss. So negative 10% is 200. 5000 times 0.2, 1000 positive. Remember, it is positive now. 7006, 4200, again positive, and 10% of 8800. How much it is? 5000, 6000, and minus 200 plus 5800. So based on, again, making the entire probability 100%, the calculation comes up that this project is likely to give 5800 versus this project which gives 5200. Which one would I choose? I would go for the higher based on, again, the entire probability method. So this is what I will choose, despite the fact that there is a chance of making $2,000 loss and the chance is 10%. Still, based on the overall analysis, it seems that other probabilities basically gives me a higher dollar value. So the chance is that I will overall earn 5800. So I'll go by this option B. This is how expected value is calculated. Expected value means take the probability of each number, each cash flow, multiply by the cash flow, and take the sum like this. Dollar value times probability, get the number. Dollar value likely to happen times probability. This total sum is here. Sigma means sum of all the P for probability, X means the value. So sigma of sum of all the number P multiplied by the value X. So take the PX, sum them up, and that is the expected value. That tells us which project to use. Let's go to the theory. Where probabilities are assigned to different outcomes, we can evaluate the worth of a decision as the EV or weighted average of these outcomes. The principle is that when there are a number of alternative decisions, each with a range of possible outcome, the decision chosen will be the one which gives the highest EV. So we have met all the criteria. Number of alternatives. See here, there are number of alternatives in both cases. Probability is also assigned, range of possible outcome given. The decision chosen will be the one which gives the highest EV. So I took the highest EV, $5,800 against 5,200 because that gave me the highest dollar value. Okay. So that is the expected value questions. Now, this question is saying a manager has to choose between these two. And after we do the calculations, it's saying both options will produce an income of 30,000. Which should be chosen? Okay. So, interesting point is both option will produce an income. Look at the word income. But the project is providing us the estimate of the cost. So we can't just say that okay, both option will produce an income of 30,000. So we can go for either of them, because ultimately we also need to consider what is the cost, right? So when we choose the cost, or when we need to look at the cost, then it will be something like this. Let's multiply 0.29 times 15,000, 0.54 times 20,000, 0.17 times 30,000. Again, these two guys together, what it will tell us, this will give us the total cost dollar. This will also give a total value in the dollar, okay, in cost. Now, because the income or revenue is the same for both, which one I'll go for? I'll go for the lower cost between C and D. Does it make sense? So let me just do a quick calculation on Excel and give the number. I'll share my Excel so that you can see. Option C, we are calculating the cost. So what is the cost for each probability? So then we have option D as well. The probability of that is, there are four probability for that. In fact, 3%, 30%, 35%, and then 32%. What are the numbers? 14,000, 17,000, 21, and 24. What we need to do? Multiply the two of these together to get the EV. Right? That is the EV. What is the total now? Interesting. So 2250 let's come back to the book and make a decision. So it seems option C is better for the fact that it has lower cost. When it comes to the cost, we need to select the lower EV. When it comes to income, we need to select the higher EV. When it comes to profit, we need to select the higher profit EV. Okay, so since the cost is higher for D but lower for C, we'll go for C. C's cost is 20,250, but D's cost is, expected value of the cost is 20,550. This one is $300 higher. So this is how we use expected value. It is important sometimes that it's not as straightforward, because sometimes some of the investor goes for high risk as well. If you give someone project like this, that if you invest $10, there's a 50% chance that you will earn $100 and a 50% chance that you will lose $100. Sorry, you will get nothing. Okay, zero. So you invest $10, 50% chance that you will get $100 and 50% chance you will get nothing. Many people will not invest $10, right? Many will be happy to invest $10 and get 100%. Even though the chance to lose and gain, chance between 100 and 0 is 50-50. So 50%, 50%. If you take expected value, what will be that? $100 times 0.5, right? $50. Then 0 times 0.5, 0. What is the EV? Sum of the two is $50, right? So expected value is $50. You are investing only $100 and expected value is $50. It is giving you almost 40% of the profit. But of course, there is a 50% chance that there will be $0 made. So that 50% chance that the $10 will be lost, that will make many risk-averse people go away from this project, despite the fact that expected value says that it is really, really profitable project. But risk-averse people don't want any risk often. So risk-averse decision maker acts on the assumption that the worst outcome might occur. But the risk seeker will look at $100 and will say, wow, that is a good chance of making good money. But risk neutral will try to make the balance of this too, and they will apply all the statistics, mathematics, or probably will go by expected value approach. Okay, that's the difference between the three: risk seeker, risk neutral, and risk averse. Risk seeking manager working for an organization is characteristically risk averse, is likely to make decisions that are not congruent with the goals of the organization, because sometimes organization and the managers don't have the same aptitude and approach. Manager may be ultra risk seeker, organization will be very risk averse. In that case, their approach will be quite different, and manager may not be congruent for the organization, or maybe the organization might not be suitable for this kind of manager. Okay? It happens many times. People feel that their goals and values are different from the organizations. This could be one of the situation. So this is called risk appetite, how much risk one is able to digest. And in the organization, it is not that entire organization has the same kind of risk appetite. Different managers, different stakeholders of the organization have different risk appetite as well. Let me give you an example. Okay. You know, management are also one of the stakeholders of the organization, and so are banks, right? Shareholders, they are also stakeholders. But if you see what is their overall approach to risk, that could be significantly different. Manager would like to take more risk often. Why? Because if you know that with risk comes the reward, and if they will take more risk, there could be more reward at the end of the year, and based on the reward they'll get the incentive and bonus. So manager may be driven to take more risk because they look at the dollar at the end of the year. If because of the risk the value is eroded, organization lose some share, or money is wasted, still it is not their own money which is lost, so they are still fine. So managers have incentive often, not in all cases, often to take more risk. Now let's go to the other side. Bankers have invested in the organization, and the bank given the loan. Banks see that if the organization takes too much risk, their money will be lost. So they don't want organization to take too much risk. So these guys will be risk averse. Managers will be risk seeker. Shareholders, based on maybe their lifestyle, their own background, which country they are based on, and also which culture they are from, they might be risk seeker or risk averse, or averse, both. So different stakeholders, different taste to, or different appetite to risk. So there has to be clarity, there has to be proper communication with all the stakeholders in order to communicate with them what kind of risk we have borne. What is our approach to risk? Are we going to mitigate the risk completely? Are we going to avoid? Are we going to hedge? or are we going to transfer? Are we sharing the risk with some vendor or other organizations? We need to have the proper communication and strategy on the risk. There could be also different types of risk. We have already discussed earlier: operational risk, financial risk, economic risk, political risk. We need to have the strategy to identify from the advanced performance management perspective. We need to be able to identify the risk, measure the risk, quantify them numerically and qualitatively, and have the strategy to address those risks. And then how it will be communicated to different stakeholders. That's what we need to identify for APM paper. A critical issue is that management are able to gather sufficient data so that they can take preemptive action before risk appetite are breached. Risk appetite, or maybe the risk tolerance. We might have a risk tolerance level. But what you do if there's a risk of breaching the risk tolerance? That's where we use derivatives such as options, swaps, forwards, or we use insurance product, or we have some vendors to work with, that is, and have the agreement. That means we are trying to share the risk. So there are different strategy to mitigate, avoid, share the risk as well. We need to have a good business acumen reflected in the exam paper. We can also look at the idea of risk appetite in relation to business strategy. For example, organization may have a management team that is very good at maintaining the business current position and ensuring that operations are running smoothly. But it might find itself underperforming in terms of shareholder returns. Okay, so that would mean that organization is good in one way but not able to give proper information or focus on what different stakeholders are looking for. So it is kind of a one-sided. Organization is not, or management is not able to understand the concerns or the expectation of different stakeholders, and if they cannot understand, they cannot address, they cannot perform, you know, as per their expectation. So what is the solution? So for that, we have a suggestion: ANSOF matrix. So that's actually shows what kind of market penetration strategy, scheming versus segmentation, what kind of market penetration strategy should be adopted so that a balance of risk, or the risk is absorbed by the organization only to the extent of risk appetite. So risk appetite of organization should be kept in mind, and the strategy should be aligned to the risk appetite. Okay, they should not, these two things should not be divorced. They should be in conjunction, there should be congruence between the strategy and risk appetite of the organization. Especially look at the situation now. Because of Corona and pandemic, many organizations are suffering from or deprived of the cash flow. Market share is also, market itself is very small. Market is shrinking. Many economies have lost 5% of the size. So in that case, one cannot pursue very ambitious strategic plan. Everyone needs to save the cash and try to survive longer until the pandemic ends. In that situation, the strategy has to be aligned to the cash saving and cash management, and hence it should also be in line with the risk appetite of the organization. So therefore, ANSOF matrix, or maybe even Mandel's matrix, which talks about the stakeholder management and how to understand the expectation, how to manage the stakeholders, those models are very important to mention in the answer for APM. We can just have one or two liner to talk about ANSOF matrix or Mandel's matrix for stakeholder mapping. Those things should be mentioned, and how it can be used to help us understand the organization stakeholders expectation and then take the appropriate strategy based on the risk appetite of the organization and also the risk appetite of individual stakeholder or a group of stakeholders. For example, we know customers are very powerful stakeholder, and so are the shareholders. If they have very low risk appetite, then don't go for a very adventurous project. Okay, so that kind of approach would be expected in the answer for APM paper. So with this, will end the session today here, and we will start the next session on decision rules, which will talk about maximin and minimax rules. That is also to a great extent related to risk avoidance, risk averseness, but we have a good background to quickly finish that one as well. So we'll be able to move faster for maximin decision. It's a simple scenario, and we'll make the progress to contribution table, etc. in the next session. Any question before we finish? Are you good? All right. Thank you for attending the session.
No question. Okay. Thank you.
Right. Excellent. Thank you so much.